Welcome back to The Explainer. Grab your notes because today we are stepping right up to the virtual whiteboard to figure out exactly how to secure that A-star grade. We're tackling one of the absolute most critical modules in the IGCSE accounting syllabus, clubs and the accumulated fund. And we are specifically zeroing in on the 2026 syllabus requirements together, so let's get right into it. Okay, here is our quick roadmap for today. First, mastering core concepts. Second, step-by-step technical execution. Third, ratios and evaluation. And finally, advanced examiner strategy. Let's go. Section 1, mastering core concepts, or as I like to call it, the foundation of financial intelligence. So we are starting off with the core concepts because this topic, it's not just basic data entry. It is literally your fundamental bridge to true financial intelligence. Think about the accounting equation. Assets equals liabilities plus equity. You absolutely must understand the duality of every single transaction. Whether you're dealing with a local club or a massive standard business, maintaining this equation continuously throughout the fiscal period is what satisfies the business entity concept. Remember, every single entry has an equal and opposite reaction. Now, there is a super fascinating tension here between the historical cost principle and the prudence concept. Students, unfortunately, violate the prudence concept all the time by overstating profits and just kind of ignoring potential losses. For example, failing to account for an irrecoverable debt makes a club look way healthier than it actually is. And let me tell you, that is a major red flag for examiners. We must never anticipate profits, but we absolutely must provide for all probable losses. And actually, that builds directly into the 2026 requirements. Cambridge has completely transitioned to modern international terminology, so precision here is non-negotiable for top marks. We have to use terms like irrecoverable debts instead of the old bad debts phrasing. Same goes for owner's equity. You need absolute 100% accuracy here because if you use outdated terminology, it instantly signals to the examiner that you just aren't up to speed. All right, here is your essential vocabulary checklist: accrued, prepaid, realization, consistency. Now, you can't just memorize definitions here. You have to actively apply these words to the complex, multi-layered scenarios you're going to face in paper 2. Like, if a club has unpaid subscriptions at year-end, you need to instantly recognize that as accrued income and know exactly how it impacts the accumulated fund. Before we jump into the actual math, let's pause and remember why we even do this. The integrity of these specific records dictates the annual decision-making processes for some very critical outside parties. Banks need to know if the club can actually handle a loan. Owners and members want total transparency on their funds. Tax authorities demand accuracy. Basically, these ledger accounts are the lens through which all stakeholders view the entity. Moving right along to Section 2, step-by-step technical execution. This is all about procedural flow and securing those method marks. This is where we take those high-level concepts and execute them using specific exam command words. Let's look at how a strict methodological approach minimizes your errors. If the exam command word is enter, we follow a very specific flow. Say a member pays a $50 subscription. Your source document is the receipt. From there, it goes straight into the cash book as the prime entry. And finally, we transfer it over to the subscription's T account. Skipping even one of these steps causes a massive cascading error. Now, the T account structure remains the absolute gold standard of the double entry system. You have got to master the art of balancing these accounts, explicitly separating your brought down balances from your carried down ones. Balance/D is your closing balance carried down at the end of the period, right? While balance B/D is the opening balance brought down for the start of the next period. Mixing these up is a remarkably common, yet entirely preventable mistake. You also need to be highly vigilant here. Miscalculating the percentages between trade and cash discounts is a huge mathematical pitfall for so many students. Listen, if a club buys equipment for $100 and gets a 10% trade discount, that $10 is deducted immediately. It never even enters the double entry. The cash discount is only applied later to that remaining $90 balance if they pay promptly. I want to stress this next point. Method marks are a crucial lifeline. In the IGCS examination, method marks are awarded even if your final balance is totally wrong, provided your logical flow is actually visible to the examiner. So always, always show your workings, especially during complex adjustments for depreciation or inventory valuation. If you just magically produce a wrong final number with no workings, you get 0. But if you show the proper steps, you can still salvage the vast majority of the points. All right, Section 3, Ratios and AO3 Evaluation, Interpreting the Real Story. So calculating a number is just your baseline skill, but identifying what it actually means for the club's liquidity or profitability, that is where the real exam points are hidden. Take a look at this massive drop in a current ratio, falling from 2.5 to 1 all the way down to 1.1 to 1. The math itself is simple, but the interpretation is where you show off your expertise, because a drop like this signals a severe, immediate liquidity issue for the entity. Okay, it's time for an interactive pause and attempt. I want you to put on your financial detective hat for a second. In the exam, you'll be asked to explain the exact causes behind a mathematical drop like this. I want you to pause this explainer right now, grab a piece of paper, and write down 3 possible accounting reasons why a current ratio would plummet this quickly. Go ahead, I'll wait right here. Okay, let's see how you did. Compare your answers to the checklist we've got here. Did you list overpurchased inventory? Because if you hold way too much stock, your cash gets totally tied up. What about paying suppliers, your trade payables, too slowly, causing those current liabilities to just mount up? Or, perhaps, cash reserves were completely wiped out by a major capital expenditure, like buying brand new equipment for the club. These are exactly the AO3 evaluation points the examiner is desperately looking for. Another massive part of evaluation is inter-firm comparison. But doing a direct comparison between 2 different clubs is super tricky because differing accounting policies alter the surface numbers. If Club A uses straight-line depreciation and Club B uses the reducing balance method, their non-current asset values and final surpluses are going to look entirely different, even if they bought the exact same equipment on the exact same day. We have to evaluate the policies behind the numbers, not just the numbers themselves. And honestly, to judge the true quality of a profit, we have to evaluate factors that are completely outside the ledger. Things like staff morale, which directly impacts operational efficiency, or location, which heavily dictates foot traffic and sales. And of course, market reputation, which drives your return on capital employed in the long run. Literally none of these are in the T accounts, but they absolutely dictate the future survival of the club. Finally, Section 4, Advanced Examiner Strategy. Direct insights straight from the 2024 and 2025 examiner reports. Let's formulate our exact exam day strategy using feedback from the principal examiners themselves. They note year after year that students lose silly marks through poor handwriting and ledger accounts and failing to distinguish between revenue and capital items. Guys, it is heartbreaking to see brilliant conceptual knowledge ruined just because of illegible handwriting. If the examiner can't read your balance C/D, they simply can't award you the mark. Furthermore, misclassifying a capital expenditure as a revenue expense throws off your entire accumulated fund calculation. So, keep this strategic checklist mapped out in your mind to help navigate the immense pressure of the exam. Write clearly in your T accounts. Ruthlessly separate your revenue and capital items. Manage your time carefully. Please don't spend 20 minutes agonizing over a simple 3-mark calculation. And always check the weightage of the question. If a question is worth 8 marks, it demands a deep, multi-layered AO3 evaluation, not just a quick one-liner. Well, we've covered a tremendous amount of ground today, right? From the prudence concept, all the way to T-account execution, and finally, some advanced examiner insights. As you go off to revise your notes on clubs and the accumulated fund, I want to leave you with this final provocative thought. Whenever you look at the data you generate, constantly ask yourself, are your financial records truly telling the full story of the business entity? Because developing that level of critical insight is what truly secures the A-star. Keep practicing those past papers, always show your workings, and I'll catch you in the next explainer.